Well, good morning. I'm Jagendra Rana. The topic for our discussion today is the concept of insurance. The concept of insurance. Every day we hear stories about accidents and other misfortunes that someone has suffered. Some of these include all of a sudden people fall seriously ill, motor vehicles are stolen and people die or get injured in accidents involving motor vehicles, house and belongings are destroyed by fire, large scale loss of lives and destruction of property in cyclones and tsunamis. Life is full of uncertainties and surprises. So, protecting oneself, one's families, and society from these uncertain events has been one of the biggest concerns of men for centuries. So, risk is a term that we use to refer to the chance of suffering a loss as a result of uncertain events like the events that gives rise to such risks are known as perils. Some example of perils are fire, landslide, flood, lightning, earthquake. So we face many such risks in our day-to-day life, including risk to our life, health, property, and so on. We don't know whether and when something unfortunate will happen to us or our family members or property. It may not always be possible for us to prevent such a happening. For instance, we cannot prevent a storm or somebody's death from occurring. It is possible for us to take measures to reduce the financial consequences that arise due to the above mentioned risks and protect ourselves financially. One of the ways by which this is normally done is with the help of savings and investments. So we would have seen or learned from our parents or elders about the need to save for the future. So by saving or investing money, the money so accumulated can be used to cope with the loss. Our such savings can only give back our own money plus some returns. What would happen if a human life is lost or a person is disabled permanently or temporarily? A person dies suddenly. Where would the person's family get the money from to support itself? How would the person's family meet the various living expenses after his death? The person suffers a paralytic stroke that leaves him permanently bedridden. Such an event would result in loss of income to the household and put the family in a lot of hardship. So the loss suffered is so large in all such situations that one's savings may not be sufficient to take care of the financial burden. So luckily for us, there is something called insurance. It is founded on a simple idea, even though an event like death or a fire can come as a terrible economic blow to someone. One will take the society as a whole, so during any given year only a few would suffer in such manner. If a small contribution is collected from everyone in the community and pooled to create a common fund, the amounts so pooled can be used to pay money to the few unfortunate members who have been subject to the loss. So insurance is a mechanism of risk transfer and sharing by pooling of risk and funds among a group of individuals who are exposed to similar kinds of risk for the benefit of those who suffer loss on account of the risk. Insurance is thus a financial tool especially created to reduce the financial impact of unforeseen events and to create financial security. Indeed, everyone who wants to protect himself against financial hardship should consider influenza insurance. So traditionally, the joint family has been an informal social security in India. In modern society, social security is available only to those who are employed in the organized sector. Insurance is considered one of the tools of social security or formal and informal sector and is largely carried out in two ways. So the first way is known as social insurance. Here the state or government takes care of those who are subjected to losses due to some risk event. Examples are providing a pension when one grows old to providing free medical treatment, meeting the cost of hospitalization, etc. So the fund for this purpose comes from a pool made up from taxes or mandatory social security contributions required to be made by all those who work and earn an income. So the employee state insurance scheme that provides medical care and other benefits to employees. Unemployed Provident Fund organizations that provides pensions and survivor benefits in the event of an employee's death are the popular schemes under this Act. The second way is through voluntary private insurance. Here individuals and groups can buy insurance from an insurance company by entering into a contract of insurance with the company. The insurance company enters into a contract, an insurance company whereby it undertakes an exchange for a small amount of money that's called premium to provide financial protection by agreeing to pay the insuring person that is insured a fixed amount of money, sum assured on the happening of a certain event that is insured peril. So insurance companies collect premium to provide for this protection, and losses are paid out of the premiums so collected from the insuring public. In other words, an insurance contract promises to make good to the insured a certain sum in consideration for the premium received from the insured. Examples are the following. Two examples explain the concept of insurance. Say, in a village there are 400 houses, each valued at rupees 20,000. Every year on an average 4 houses get burned, resulting into a total loss of 80,000. The number of houses 400, the value of each house is 20,000. Houses that get burnt every year 4. Total loss 4 houses into 20,000, 80,000. The contribution to be made by 400 house owners to compensate for loss of 80,000. Rupees 80,000 upon 400, that is rupees 200. So if all the 400 owners come together and contribute to be 200 each, the common fund would be 80,000. This is enough to pay 20,000 to each of the 4 owners whose houses got burnt. Thus the risk of 4 owners is spread over 400 houses or house owners of the village. Another example is that there are 1,000 persons who are all aged 50 and are healthy. So it is expected that of these 10 persons may probably die during the year. So if the economic value of the loss suffered by the family of each dying person is taken to rupees 20,000, the total loss would work out to rupees 2 lakh. The number of persons 1,000, the economic value of each person 20,000. Person that may die during the year probably 10. The total loss 10 into 20,000, 2 lakh rupees. So contribution to be made by 1,000 people to compensate for loss of 2 lakh rupees. That's 2 lakh upon 1,000, that is rupees 200. So each person of the group contributes rupees 200 a year. The common fund would be rupees 2 lakh. So this would be enough to pay rupees 20,000 to the family of each of the 10 persons who may die. Thus 1,000 persons share the risk of loss due to death suffered by 10 persons. So it can be seen that insurance is a very useful financial tool for pooling, sharing and transfer of the risks so that the financial loss caused to a person who suffers due to peril is compensated. There is a case study of risk and protection. Sheetal and Simran are friends from the same class and regularly go home together. Now Sheetal always carries an umbrella and Simran makes fun of her. Sheetal simply smiles and says that as the umbrella protects her from the sun and rain, she does not feel it to be an additional burden to carry along with textbooks in her school bag. One day it suddenly started raining. Simran did not get either raincoat or umbrella, but because of which she got wet as did her bag and books. So Sheetal used her umbrella to protect her and her bag from rain. Sheetal offered to share her umbrella and asked Simran to come to her house. So after reaching Sheetal's home, Simran found that Sheetal's father was carefully sorting out a bunch of papers and making notes. So Sheetal's mother had refreshments, arrangements for all of them without making much noise. When Simran asked Sheetal's mother why Uncle Ji was so serious, he said, actually, your uncle is finalizing papers for purchases of an insurance policy. Now, what is an insurance policy? Simran inquired. Sheetal's mother explained, insurance offers protection against unforeseen risk, just like a raincoat or umbrella protection against him. So what is the risk? Simran asked. Sheetal's mother replied, see Simran, we face many risks in our lives. For example, if you drench yourself in rain, you may fall sick. There is a risk of illness due to rain. There could be a short circuit or electricity. There is a risk of electronic breakdown of this TV as well as other domestic appliances. There is a risk of theft of our car which is parked in the garage. And there is also the risk of an accident while crossing the road. So risk is an inherent part of our life. Whether and when loss will be caused because of risk and how much loss is caused cannot be foreseen. So known or controlled at all times, while we cannot avoid most of these risks. By purchasing insurance, we can transfer the risk to the insurance company. Someone asked, how does this happen? Sheetal's mother explained. Suppose the downpour is heavy, resulting in a flood. Our car could get immersed in water. It could damage a few vital parts necessitating repairs. Since we have insured our car, the insurance company will reimburse the expenses of repairs, thereby reducing the impact of loss because of damage to the car. So Simran asked recently, what auntie? Why cannot the rain be stopped and then ceased? Sheetal's mother explained, bless you, and told her, had you taken an umbrella, you could have protected yourself from getting wet. See now, since you got wet, can we stop you from sneezing? Everyone laughed. So this is the example of risk. Now see, to know that insurance laws of large number, insurance is a law of large number. Imagine that in a village there are 1,000 persons who are all aged 50 and are healthy. Based on previous experience, it is expected that all of these 10 persons may die during the year. If the economic value of the loss suffered by the family of each dying person is taken to rupees 20,000, the total loss would be worked out to be 2 lakh. If each member contribution or contributes to be 200 a year, this would be enough to pay 20,000 to the family of each of the 10 persons who dies. So you would have wondered whether the prediction of number of actual deaths of 10 is accurate. What will be the impact of if the insurance company's predictions about the risk turned out to be wrong or inaccurate and the number of deaths turns out to be 15 or 5? If the actual number of persons who died during a year were to be higher than 10, the amount collected would not be sufficient to compensate those who suffered the loss. So you need not worry too much about the accuracy of estimates. What sets the insurer is a wonderful principle of nature, known as the law of large number. Simply put, it states that the more the number of members who are insured, the more likely it is the actual result would be closer to the expected. Say, for example, try this simple experiment. Toss 1 rupee coin. We all know that the theoretical probability that the outcome will be heads is equal to half. Does that mean that if you toss a coin 4 times, you will always get 2 heads and 2 tails? So when can you be 100% sure that you will get heads exactly half the time? The answer is you would have to toss a very large number of times. You would also notice that the more number of times you toss the coin, the more you would find that the result is coming closer to half. The law of large number on number of tosses of a coin says that insurance works on this law of large numbers. Insurance companies are able to make near accurate predictions about their risk because they typically spread this risk amongst thousands, even millions of members who have signed contracts with them and who are their policyholders. So this is the reason why when you purchase an insurance policy, the insurance company is able to give you an assurance that your losses would be compensated if they occur due to the insured event. Another factor is insurable interest. There is another important principle is insurable interest. So let us understand it with the help of a example. For example, Sri Manoj was staying with his wife and son. An insurance agent visited him offering health insurance. So Manoj indicated that he wanted to take health insurance for all the members of his family. He also wanted to take a policy for his good neighbors. But the insurer said the Manoj can take a policy for this limit, but cannot take a policy for his neighbor. The reason why the insurer refused to issue insurance policy to Manoj's neighbor because Manoj did not have an insurable interest in his neighbor's health. So insurable interest is the term used to describe the relationship between the insured and the subject matter of insurance. So in our case, it is the health of Manoj and his family on one hand and the Manoj's neighbor. So the relationship gives Manoj a particular type of interest in the health himself. So his wife and child, whereby he finds from the good health and suffers a financial loss by way of hospital expenses, is one of the methods of his family policy. We buy insurance to ensure that the loss suffered is compensated in some way. So the position is not so in case of Manoj's neighbor, as Manoj does not suffer any financial loss due to his neighbors failing him. Insurable interest exists when an insured person derives a financial benefit from the continued existence of the insured subject or suffers a financial loss from the loss of the insured object. The person has an insurable interest in something when the loss of or damaging to that thing would cause the person to suffer a financial loss. Thank you. Thank you very much.